In the world of retirement planning, the standard advice is often delivered with an air of absolute certainty. It's the Roth mantra, the suggestion that you should aggressively move your money from a traditional IRA into a Roth IRA as quickly as possible. The logic is clear. By paying taxes now, while historical rates are low, you protect your future growth from the IRS, ensuring every dollar you withdraw later is yours to keep. This creates a psychological illusion. Retirees often view the conversion as a simple lateral transfer, a clean, isolated move between two identical financial buckets. Because the focus is entirely on the long-term benefit of tax-free growth, it becomes easy to ignore the immediate mechanical reality of how that money is processed. The Roth account is an excellent tool, but treating the transfer itself as a harmless shift in assets leads to a severe miscalculation of the actual cost. When we move from theory to the tax code, the definitions become much more rigid. The IRS does not recognize the concept of a lateral transfer. In their eyes, moving funds to a Roth account is a taxable event. You are choosing to manufacture new taxable income in a specific calendar year, which means that money must be added to everything else you earned that same year. Take a 62-year-old retiree who decides to move $100,000 into a Roth account, believing he's following a prudent path. He calculates the tax bill for that $100,000 as if it exists in a vacuum, completely separated from his financial life. But the tax code never looks at income in isolation. The danger of the conversion has nothing to do with the Roth account, and everything to do with how that new income stacks. To understand the cost, we have to look at the full reality of a household's annual earnings. In this particular scenario, the retiree's spouse is still working her final year, earning a high W-2 salary. This chart shows how the IRS fills tax brackets. This base salary enters the calculation first, occupying the lower, less expensive tiers of their tax obligation. Then, a second variable. Earlier that year, the couple sold real estate, resulting in a significant capital gain. This profit doesn't sit next to the salary. It stacks directly on top of it, moving the household further up the income scale. The retiree proceeds with the conversion as if this existing stack of income doesn't affect the cost of the transfer. He moves $100,000 into the Roth account, unaware the room in his lower tax brackets is gone. Because the conversion is new income, it's forced to the very top of the stack, breaching the threshold into a much higher tax bracket. This forces that $100,000 to be taxed at a rate far higher than the retiree projected, making the maneuver more expensive than if he had simply left the money alone. The promise of future tax-free growth has been replaced by a massive, immediate bill that the household hadn't budgeted for. The strategy failed because the timing of the income stack transformed a wealth-building tool into a financial trap.
Picture a quiet morning. You are sitting at the kitchen island, reviewing your retirement accounts, and deciding to finally execute a Roth conversion. The appeal of tax-free growth for life is significant, but a conversion moves the deadline for your tax liabilities, pulling a future obligation into the current tax year. When you contribute to a traditional IRA or a 401k, you are depositing pre-tax dollars. The government granted you permission to delay paying taxes on that money and on every dollar of profit it generates over the coming decades. The IRS maintains a record of this unpaid balance, waiting for the decades-long deferral period to end. The exact moment you convert those funds to a Roth account, you are actively breaking that long-standing tax deferral agreement. You are walking up to the IRS and volunteering to settle your entire unpaid balance immediately. Initiating this taxable event requires an exact understanding of your current tax year, or you risk paying more than necessary for a strategy intended to save you money. To understand the cost of that timing, we have to look at the institutional reality of the American tax code. We operate under a progressive tax system. Different thresholds of income trigger sequentially higher tax rates. A common error many investors make is assuming that the money they convert to a Roth is taxed entirely on its own, starting from zero at the lowest baseline rate. This visualization maps out how those thresholds actually behave. Converted retirement funds are always poured in last. That money stacks directly on top of your salary, your dividends, and every other source of income you earned that calendar year. If you convert $20,000 during a low-income year, that money might sit comfortably inside a 12% bracket. But if you convert $200,000 all at once, the sheer volume forces the excess capital to spill up into the 24%, 32%, or even higher brackets. This mechanical reality, tax bracket stacking, can significantly diminish the tax arbitrage that makes the conversion attractive in the first place. Let's say you are sitting in an airport lounge, running the numbers on your phone, and you decide to accept the tax hit anyway. You still face the problem of liquidity. In a stable scenario, you have cash reserves sitting in a standard external savings account, completely separate from your retirement funds, ready to pay the IRS. The destructive alternative happens when you lack outside liquidity. To cover the tax bill, you decide to siphon the money directly from the retirement funds you are trying to convert. Looking at this flow diagram, you can trace exactly what happens to the math. You convert $100,000. You divert $25,000 to pay the taxes, leaving only $75,000 to actually enter the Roth account. By paying the taxes from the inside, you permanently shrink the principal balance of your tax-free account before it even has a chance to grow. You destroy the raw capital required to generate compound interest. The wealth you intended to protect is dismantled by your own payment method. The IRS processes these voluntary transactions with cold mechanical efficiency. They view that $25,000 internal tax payment as a distinct distribution of funds. The tax code enforces a strict threshold, 59 and a half years old. If you are younger than that, the IRS legally categorizes the money you use to pay your taxes as an early withdrawal. They instantly assess a flat 10% penalty on top of the income tax you already owe. Bracket stacking forces you into premium rates. Internal payments consume your principal capital, and age thresholds trigger compounding penalties. This exact sequence is the blueprint for a cascading financial failure. Successfully executing a Roth conversion requires passing a strict set of mathematical prerequisites before you ever authorize the transfer. You need total awareness of your household's unique tax topography. You must map out your current marginal brackets and calculate exactly how much room you have before triggering the next tier. You also have to navigate the pro rata rule. If your traditional IRA contains a mixture of both pre-tax and after-tax funds, the IRS applies a strict ratio to your conversion, creating an unavoidable layer of taxation on money you thought was already cleared. And most importantly, you must hold the external cash liquidity required to physically pay the bill without touching your retirement principal. The entire burden of responsibility rests on you to navigate these rigid rules correctly. The IRS does not hide its mechanics. The penalties and premium rates are clearly written into the code, and they are triggered in broad daylight by voluntary miscalculations. The success of the strategy depends on controlling the volume of the conversion and possessing the outside cash to fund it. Without those two factors, the conversion becomes an expensive, voluntary donation to the Treasury.
Many retirees look at a massive IRA balance and decide to make a seemingly rational move. They convert $100,000 to a Roth IRA, securing future tax-free growth. We naturally separate our financial lives into isolated folders. We calculate the income tax on that conversion, pay it, and assume the transaction is finished, completely walled off from our healthcare costs or government benefits. But that conventional wisdom ignores a concept financial planners call income adjacency. The government does not see isolated folders. They operate a highly sensitive, interconnected network. When you trigger a major change in one ledger, it instantly alerts the others. That invisible, systemic interconnection turns a single tax strategy into a financial wrecking ball, breaching government agencies you never intended to involve. If you look closely at a standard Form 1040, that $100,000 Roth conversion registers immediately. It creates a massive one-year spike in your modified adjusted gross income. That inflated income data doesn't stay at the IRS. It is automatically fed into the relentless machinery of the Social Security Administration. Then the system goes quiet. For 2 full years, there is a built-in delay where absolutely nothing happens, lulling you into a false sense of security. 2 years later, the echo arrives. You receive a cold, official notification from the government outlining your IRMAA penalty, the income-related monthly adjustment amount. Because of that income spike from 2 years prior, Your Medicare Part B and Part D monthly premiums are forcibly pushed into the highest possible penalty bracket. The thousands of dollars you thought you saved in future taxes have been mathematically vaporized by cascading healthcare surcharges. The second tripwire attacks an entirely different asset, your Social Security benefits. The tax-free status of your monthly benefits is never guaranteed. It relies on a strict metric known as the combined income formula. A safe combined income level is crushed by a $100,000 conversion. This artificial weight inflates your metric into a red danger zone. This acts as a trigger. The expanding red area drags up to 85% of untaxed Social Security benefits into the taxable bracket. You are now paying a phantom marginal tax rate, a hidden penalty that simple online tax calculators completely fail to detect. Every dollar you convert blindly forces unrelated retirement lifelines into the line of fire. The final tripwire is a matter of disastrous timing, usually made by retirees approaching their 70s. Desperate to avoid the mandatory withdrawals enforced by the IRS, known as Required Minimum Distributions, or RMDs, people rush to move their money into a Roth. They execute these massive conversions in the exact same calendar year they are forced to take a heavy distribution, or even worse, the year they sell a major asset like a home. This graph demonstrates the goal of tax smoothing, keeping your burden flat over time. But when you stack a conversion on top of major windfalls, you build a narrow skyscraper of income that punches right through the ceiling of your highest tax bracket. Panicking over IRS rules without looking at the entire calendar creates the exact catastrophic tax bill you were trying to escape. A Roth conversion is an incredibly powerful wealth preservation tool. The mechanism itself is not the problem. The enemy is the blind conversion. It's the simplistic, loud advice treating the Roth as a universal cheat code, ignoring the systemic consequences. Professional planning requires a patient, multi-year strategy, moving small, calculated amounts over time. This diagram illustrates a tactic called filling the brackets. Planners identify specific low-income gap years, usually after retirement but before Social Security begins, and carefully pour calculated amounts exactly to the brim of the lowest tax containers. True financial strategy demands that you anticipate the cold, interconnected logic of the Internal Revenue Service and the agencies it talks to, long before making a single irreversible move. Stop. Before you pick up the phone to call your broker or click execute on your trading platform, take your hand off the mouse. You are standing at the due diligence gate. This is a 5-point institutional review process that must be cleared before a single dollar of capital is moved. Hitting execute without running this checklist is an act of gross negligence with your family's life savings. This specific checklist is mandatory, and you need to review it directly with a licensed CPA or a certified financial planner. View a Roth conversion as a neutral tax event, a calculated exchange of immediate liability for the possibility of future tax-free growth. Skipping this institutional review guarantees that a theoretical tax-saving tool will trigger a massive unintended tax bill. The first gate checks the tax year. The liability of a conversion is locked into the calendar year it is executed. Look at your current household income. If this year includes any anomalous cash flow, a severance package, an inheritance, or the sale of a property, halt the conversion immediately. You are forcing that new income into a higher bracket. The second gate examines adjacency interactions. New converted income radiates outward, directly impacting external tax and healthcare systems. The first systemic collision happens here. This document shows your historical earnings record. When you add conversion income to your tax return, it alters the formula that dictates how your Social Security benefits are taxed, pushing more of your benefits over the taxable threshold. The second collision triggers the Medicare IRMAA surcharge trap. Look at the coverage dates on this Medicare card. Because Medicare looks at tax returns from 2 years prior, a conversion executed today can spike your monthly Medicare premiums 2 years in the future. If you are on the Affordable Care Act, crossing a strict income threshold with your conversion will instantly vaporize your premium tax credits. Your healthcare costs will rise overnight. Failing to verify these interactions transforms an attempt to save on taxes into a multi-system cascade of financial penalties. Gate 3 introduces the liquidity mandate. From what specific account will you draw the cash to pay the tax on this conversion? The institutional rule here is absolute. Never pay the resulting tax bill using funds withheld directly from the IRA itself. If you withhold the tax directly from the converted amount, you permanently reduce the future tax-free compounding power of that capital. You must have external liquidity. You need sufficient cash reserves sitting in a standard bank account, ready to absorb the invoice from the IRS. If your household lacks the outside liquid cash to cover the tax, the conversion is mathematically destructive and the transaction must be aborted. Gate 4 deals with the IRS pro rata rule. This single mechanism causes severe financial shock for investors attempting backdoor strategies without professional oversight. Many investors believe they can selectively convert only the after-tax portion of their IRA, structured like this container, to avoid paying taxes. The IRS operates on a different framework. They ignore the distinct boundaries within your individual accounts. Instead, they aggregate every traditional IRA balance you hold, merging the pre-tax and after-tax funds into one blended total. When you make a conversion, the IRS applies the pro rata rule. They tax the conversion proportionally, based on the overall ratio of pre-tax to after-tax dollars across that entire blended pool. Because the IRS enforces this proportional calculation, a completely tax-free conversion is impossible if you hold pre-tax balances in other accounts. Ignoring the pro rata rule guarantees a tax invoice that ruins the strategy's projected return on investment. The fifth gate assesses demographic vulnerability. Is your conversion a single-year move, or are you building a multi-year strategy? Multi-year plans carry a specific risk. Consider the scenario of sudden widowhood occurring in the middle of a 5-year conversion schedule. The legal consequence is documented right here on Form 1040. The surviving spouse's tax filing status shifts from married filing jointly to single. This checkbox shift means tax brackets are instantly compressed by half, forcing your planned conversion income into a higher marginal tax rate. Any multi-year conversion strategy is reckless if it has not been stress-tested against the bracket compression of this widow's penalty. In the defense of retirement assets, financial naivete is the most expensive tax. The maneuver itself is a value-neutral tool. Success rests entirely on the accuracy of your projections and the timing of your execution. When calculated surgically and pushed safely through all 5 gates, it becomes a permanent defense against the tax burden of your retirement years. But if you execute it impulsively, driven by internet hype, fear, or greed, the IRS will simply issue a devastating, unappealable invoice, and you will inevitably pay that bill using the exact capital you spent a lifetime accumulating.